Wow, what a week we've just seen. Massive volatility within financial markets, of course, primarily within the energy space, but also seeing significant moves taking hold across many other asset classes. And the war in Iran looks to be waging on into a second week. Alongside that, we've got the likes of the US CPI and Core PCE inflation metrics coming hot on the heels of a pretty shocking jobs report in the US. And we've got earnings from Oracle. So, yes, another big week ahead to look forward to. And as ever, we're going to kick off with the overlook in terms of exactly what's happening for the week ahead and big ticket items on trading economics calendar. You can see Monday, inflation out of China, the Westpac consumer confidence figure out of Australia, then trade data out of Germany and China on Tuesday, existing home sales out of the US. Then things start to warm up a little bit with the CPI numbers coming out of the US on the Wednesday. And things really get going on Friday as we close out the week. GDP, just one of the UK metrics coming out that morning. Jobs report out of Canada, core PCE price index, inflation data out of the US, durable goods, JOLTS job openings. Yeah, it's a busy Friday to say the least. And let's kick off with that outlook for the US. Of course, right now, everyone's looking towards what the US are doing elsewhere in the world, but certainly the US economy has come back into focus following a jobs report that was a bit of a shocker, minus 92,000 jobs for the month and downgrades to the prior 2 months that brought the December figure into negative territory, a rise in terms of unemployment and an unwelcome rise in terms of wage growth, just as we see inflation fears start to rear their head once again. Now, the rise in terms of oil prices, of course, can have a hugely detrimental effect on the global economy if it continues. And we don't necessarily know how long that's going to be, right? So when this conflict in Iran first started, people thought this could be a sort of short, sharp event. And a few days later, it's kind of forgotten about. And we've grown so accustomed to this whole taco thing of Trump essentially just kind of going up to the line and then backing off and getting some concessions. This time around, it seems different. And this time around, it has perhaps the biggest consequence of it all, because the flow of goods, of chemicals, of oil, of gas, all of it's massively interrupted. And it's the kind of thing that can have some really significant consequences if it continues forward. And the main fear for markets right now would be around the rise in terms of energy prices and how that impacts inflation. Now, you could say, well, even if this goes on for a month or two, it's only a short, sharp move, and then we could be back down to $70 a barrel. That may be the case, but it may not be the case. It may be the case that essentially the sharp move higher ultimately damages some of the plants that have, well, some of them are already been attacked. Some of them, if you have to shut them down, means that you're going to possibly have a difficult time getting them back up and running. Ships aren't where they should be in the world. So I don't necessarily think it's just going to be a short-term effect. If it plays out for, say, a month, the impact isn't just going to be one spike in terms of a monthly inflation gauge. I think it's going to have a longer lasting impact. Now, we're kind of getting ahead of ourselves because we're talking about Iran, which is something that I'll talk about as well. But really, it does highlight the fact that given that the week ahead, we're going to be talking about inflation, whether it's the Fed's favorite core PCE metric, which is expected to come in at 0.3 for the month, or the CPI numbers, which is expected at 0.2 and 0.3 for the core and the headline, respectively. Ultimately, these metrics are going to become really important, because if we see energy prices remaining elevated, then we really need to see exactly what that does in terms of inflation and what that does in terms of the expectation around monetary policy. Now, Fed members may essentially come out and say that they see this as a temporary shock to the system and something that they're going to be able to look through. That may be the case. It may not be the case. But many members have been cautious in the first place, quite frankly. In terms of the inflation numbers, what's interesting here is that the Fed's favored core PCE price index is, in actual fact, remained relatively elevated as the CPI figure drops. Of course, we've seen disruptions, so some of these charts are a little bit more disjointed than usual. But essentially what we're seeing here is this divergence as CPI is coming down, the core PCE metrics a lot closer to that sort of 3% mark. And so what we need to see is both of them sort of trending back towards the 2% mark. What we can see here is the headline inflation is expected to come in at 2.4 and 2.5 for the core, so just remaining steady. In terms of the core PCE price index figure, we don't have it on this chart for some reason. That's a bit strange. Nonetheless, I mean, I don't think it's necessarily going to come down in a meaningful manner. And even if it does, I mean, quite frankly, the fears right now are around a resurgence in inflation, and that's not going to be priced into these metrics anyway. So a lot of the time, markets will just look beyond what's happening now if it doesn't actually count what's happening in the real world, which is a sharp spike in terms of energy that could ultimately lift prices across the board. This is the sort of breakdown in terms of the latest payrolls figure that I alluded to. You can see that minus 92,000 figure. What I think is interesting about this is that you've got 11 different sort of segments of the economy that they break it down into. Only 2 out of the 11 saw job creation, job growth for the month of February. The remaining 9 all in negative territory. And that has been something that, you know, has been a major concern of late, right? Even if we saw a beat in terms of last month's figure, it was 130K. I think that got downgraded this time as well. But ultimately, you know, it's not spread throughout the economy. It's like 1 or 2 segments of the economy. And the fact that like 9 out of the 11 are contracting, that is really concerning. Now, the problem here is that the US is now essentially stuck in a position where the Fed's too fearful to act. This is potentially, we need to see what all the Fed members are saying, too fearful to act because of the inflation concerns, or certainly markets are perceiving it that way. And at the same time, the US economy is suffering. So the US economy is in trouble, but the Fed can't save them because of inflation, because of the oil price rise. That is a difficult place to be. And certainly when it comes to monetary policy, people just take it as a negative and think that, you know, they're not going to be able to sort of rescue things despite the weakness that we've seen there. And this is evident here with it's a 5-minute chart, and I'll show you it live in a second. Essentially, it's a 2-year yield overlaid on the US dollar index. And what's notable here, of course, is the 2-year yield. We've seen some pretty significant volatility around that US jobs report, which is on the right-hand side here, where we saw that initial sharp sell-off and the dollar sold off, and then a rebound and the dollar recovered. And so this really highlights that people are trying to gauge exactly whether this is going to have a tangible impact on the Federal Reserve. Essentially, what markets are quite used to is when you see a very poor jobs report, then you immediately think, oh, the Fed's going to act. And that appears to be the case that what's happened here, right? Markets just saw the really weak jobs numbers and the algos obviously reacted and thought, right, this means the Fed's going to start to ease in a more dramatic manner. And then it doesn't take long for you to start thinking, inflation could be a really big problem right now. And that is likely to hamper their ability and willingness to be able to cut rates, unless they manage to draw a line under this conflict pretty swiftly and minimize the damage being dealt. In terms of market expectations, you can see here, this is for where rates will be at the back end of the year. And things have been trending more towards the idea that we're going to see very few rate cuts rather than a number of them. And that, of course, has implications in terms of market pricing. Let's just jump onto the chart for the dollar index. This is the 2-year in the blue line. So you can see starting to weaken a little bit, and the US dollar also sort of following suit. Let's go on a 1-hour chart. You can see, look how closely this is trending. So really, you're seeing that this really reflecting that sentiment around what the Fed's going to do. So if you have a view on one way or another, then you know it would have an impact on whether the US dollar is going. Let's just look in terms of the wider context, though. Here's the weekly time frame. So we've got, in actual fact, let's go on a monthly. We've got this potential for this retracement phase to be over, and the bullish trend sort of instigated in 2008, 2007 could come back into play following a drop down into the 76.4 fib. That's a possibility, and certainly what we have seen recently is a rally up into your first sort of port of call, which is 99.5 essentially. Certainly, if we break up through the 100.4, then you're looking at a double bottom formation and the possibility of a rally into this big area here. Yet to see exactly how this plays out. And certainly as things stand, anything that sort of hinders the Federal Reserve is likely to boost the US dollar. And of course, the rise in terms of oil prices is doing exactly that. If I was to just overlay US crude, not necessarily something I've made earlier, as they say, but let's just see exactly what's happening. So not necessarily perfectly tracking it at all times, but certainly you have periods where it tracks it pretty well. And most notably, if you look at, say, the near-term trajectory, you can see there's a close correlation between the trajectory of the US dollar and oil. And that means that people essentially perceive this rise in terms of oil to be inflationary and to be the kind of thing that would hinder the ability of the Federal Reserve to cut rates, which lifts the likes of the 2-year yield, which lifts the likes of the US dollar. So if you think oil prices are going higher, which I do, then it does point towards the possibility of further upside to come for the US dollar. And like I said, we're sort of hanging around this resistance level, 99.5. If we break through that level, the next big level is that 100.4. So yeah, that's going to be a massive market to follow as we move throughout the week ahead. And the next one I wanted to talk to you about, of course, is around oil. And we can see here the pricing around exactly what's influencing oil right now really has sort of shifted significantly away from supply demand dynamics and instead towards geopolitical risk considerations. And essentially right now, the whole story is all around Iran. Now, a few things I sort of wanted to highlight to you guys. And firstly, one of the key things that's really driving sentiment is the question of how long this is going to go on for, because essentially the longer the conflict goes on for, the longer the disruptions are happening in the Straits of Hormuz, and we see a ramping up in terms of attacks on refineries and things like that, the higher the oil prices go. So as we can see here, Trump started off, it could be a few days. Then it's, it could take 4 weeks or less. Soon enough, it's going to be a bit over a month. Now, Hegseth is, I heard, you can see it here, it could be up to 8 weeks. And now apparently the Pentagon is saying this could last through to September. This is the complete opposite from what markets really want to hear. And certainly that is in no small part sort of highlighting or influencing exactly why we're seeing oil prices sharply higher. Another thing, Qatar's energy minister warning that this could bring down the economies of the world. No doubt the rise in terms of energy prices could ramp up prices, could absolutely batter companies and their profit margins. Some companies just wouldn't be able to get the products that they need to essentially operate, depending on what they do. But he's talking about a shutdown of production within weeks, driving oil to $150 a barrel. So it's continuing to rise. We could still have plenty to go. This is going to be a key element of it, right? So essentially, each country has their own storage facilities, and some are bigger than others, and essentially some will have more space than others. And so essentially, they can continue to create, they'll keep their operations going, and they will fill these storage tankers without the ability to export, essentially. But once those storage facilities are full, these countries are essentially going to have to shut down production. I mean, the oil's got to go somewhere. You're not just going to sort of throw it away. So once they shut down production, then you have question marks on how long it takes to get production back up and running on the other side once there's a resolution. So oil that's not being created, obviously, is just lost. So we have a shortfall in terms of the barrels per day that are being created compared to normal. But also you've got the possibility that maybe it takes weeks or months to get some of these operations back up and running, particularly because Iran has been targeting a number of them. And so the first places you want to look out for are Iraq. And bearing in mind, these numbers are measured from the first day of the conflict. And I think we're near enough a week in. So Iraq and then Kuwait, which I've just seen a headline today noting the possibility that Kuwait could essentially shut down their operations. And then you've got a bit of a gap, and then you start to look towards the likes of the UAE, Qatar. We've already seen Qatar shutting down their LNG. Iran, well, Iran will probably try and do their best to export if they can, but I guess they've got their hands full. But all of this really pushes up the price of oil. And this is the key thing, right? The strategy of the Iranians, I think most of us coming into this conflict thought they were going to be attacking Israel or US positions. They have really gone after the world by attacking their regional neighbors and attacking different oil and gas infrastructure. And so the continuation of that would undoubtedly have the effect of driving up oil prices even more. bearing in mind Saudi Arabia have been utilizing a pipeline that they've got, the east to west pipeline, to then get their oil out into the Red Sea and through the Suez Canal. Now, they have ramped up the amount that they are sending through that. That, to some extent, is alleviating some of the issues. But of course, it's an easy target for Iran. As far as I know, it's above ground. And you also have the question mark of whether the Red Sea passage just gets shut down with the Houthis coming into play once again, like they have done in the past. And then that would just make things even worse, So this is really a very tough situation that I don't necessarily know what the resolution is beyond essentially just saying, all right, never mind. I don't think that Trump has an easy solution at all. I don't think the Iranian regime are going to take it lying down. And even if they did essentially get eradicated, it seems to be the case that there's such a decentralized operation when it comes to launching these rockets and drones that they'll just continue even if there's not many of them left, and probably have a list of targets that get increasingly more important. And the likes of the east to west pipeline would undoubtedly be one of them. The desalination plant for the UAE, that would mean that people within Dubai really suffer. Certainly Dubai, in terms of the flow of food and drinks, essentially, that's another thing that's potentially going to be impacted. The longer this goes on, the pressure really is going to ramp up on the US. And I know that the US can say, oh, so we're happy to do this until September. Yeah, that may be fine for the US because they're talking about just, the use of rockets and military equipment and personnel. But for people living in that region, they're not going to go until September. They're not going to be happy with that at all. Let's just look at the chart right now. I mean, every single time that I look at the chart for oil, it just keeps going up, and I've just seen it 12%. So it's gone up again. So WTI up 12% on the day. This is the weekly figure. There you go. I mean, it's incredible. We started off the week around $65. We're around 89. It's not going to be long until we hit $100. That's what I believe anyway. I mean, we're not that far away from it. You look at the gains that we've seen here, 65 up to 88, 89, $100. Looks very likely. And I mean, look, let's talk of $150. So we could see this really providing the basis for massive moves in the weeks ahead. And it's really interesting because, of course, we've just come off the back of a period where all anyone's talking about is oil, is gold and silver and precious metals. It feels like everyone's jumped off of that, and suddenly now everyone's talking about oil, and oil is the big thing. And it definitely is the big thing. It's an absolutely huge historic moves that we're seeing at the moment. And right now, I just don't necessarily see where the solution is going to be. I don't hear anything that makes me think they're about to suddenly come out of a resolution. And the fact is, they've killed so much leadership in Iran. Who's going to agree to essentially back down? I just don't see how it plays out in a positive manner over the short term. So in all likeliness, the US and Israel are going to continue to take out targets. The Iranians are likely to continue to send in rockets to key infrastructure to try and cause disruption, to get the neighbors to put pressure on the US and Israel. And we're likely to see further upside in terms of oil prices. So here's the hourly time frame, which is probably about the right context to be looking at it in. And we can see, how we kick things off and we start sort of moving higher gradually, and then soon enough we've just seen a strong move higher towards the back end of the week. Now, I actually think we're probably likely to see some profit taking coming into play because, quite frankly, I don't think anyone really wants to hold this into the weekend. Now, there is a strong possibility that if you hold it into the weekend, you wake up Monday morning and you think, oh wow, okay, fine, the weekend's seen things get even worse, which is probably the most likely event, right? But the flip side is, you could see a major gap, right? I mean, you're going to see a major gap in either direction. I think there's risk on both sides of that coin. And I generally, personally, don't like holding into the weekend because when you see a gap in your favor, great. But it feels like too much of a risk. And if you see a gap against you and you see your account suddenly just wiped out, basically it won't hit your stop loss if there's no trading at the prices that your stop loss is at. So, yeah, I think we'll probably see many people within the markets taking a bit of profit. So I think we will see another little bit of a retracement before the weekend. Maybe I'm wrong. Maybe it just keeps rising and rising, but that's how I see it. Anyway, then finally, let's just wrap things up with a quick look at things from a earnings perspective. Earnings season pretty much done, quite frankly. But I thought it was quite interesting that we've got Oracle coming up. And Oracle's been a pretty interesting story, actually. Of course, it's not one of the Mag 7 names, but it's certainly one at the forefront of the AI move. And in actual fact, for many the whole AI story, the over leverage, the taking on of debt, the circular economy within different AI names, OpenAI, NVIDIA, all that kind of stuff. Oracle is like perfectly positioned within that to be kind of the fall guy, right? Everyone thinks that they're probably going to be the first ones to really fold if we do see that happen. I've just got a chart here that I like to show you guys just to show exactly how things are shaking up of late. And this is, I'm just going to have to zoom in myself. My eyes aren't that good. So this is just showing how things have been working out over the past few days. Bearing in mind, I did make this yesterday on Thursday, so things have moved a bit since then. But you can see this is relative, right? So it should generally be that like half of them are positive, half of them are negative, even if the markets are going up or down, because it's relative to the market. So the outperformers have been consumer discretionary, information technology, financials, and telecoms. And then at the bottom end, materials, consumer staples, industrials, real estate, utilities, and energy. I mean, essentially, if you're looking at the top end, you're looking at consumer discretionary. So you're looking at something that I'm quite surprised is up there, quite frankly, because what I'm expecting here is that the weakness comes from those that are going to be heavily hit by higher energy prices. So you can see at the bottom end of this, materials, yup. Industrials, yup. Materials also going to be impacted. Say copper production relies heavily on some of the chemicals that are going to be impacted by the closure of the Straits of Hormuz. Energy not necessarily doing all too well. I mean, ultimately, we've seen plenty of fluctuations, but it has been moving in one direction. I think there's a great degree of hesitancy when it comes to buying some of these oil and gas names because there's a perception that maybe in a week's time prices just come back again. And so you can trade it on the short term and make gains on the profit that's happening today in WTI. But does that mean that your oil and gas major is suddenly going to have huge earnings for the quarter or for the years ahead? And that means that all the investors pile in? Maybe not. Maybe not. I mean, it really depends on how long this lasts for and how much of an extended impact this has on prices. But notably, we have seen some of the software stocks doing pretty well, and sort of tech names, which is a move back to a theme. Remember, the theme all of a week or so ago was all around the idea that AI is essentially going to make all these companies bust. And so AI stocks were suffering, software stocks are suffering. Now, all of a sudden, it's like, oh, well, actually, we don't want physical companies because they rely on oil and gas. They need energy to be able to function, to be able to create their products. They need some of the chemicals and materials coming through the region. Therefore, how about we just jump back into the tech companies that maybe don't rely so much on those kind of things, and certainly sort of software falls into that. So the rotation between different narratives has been pretty incredible of late. In terms of Oracle earnings, we can see that here in terms of earnings per share broken down. Let me just get rid of my big old head. Oh, that's only my head. Here we go. So yeah, in terms of market expectations, you can see it's been pretty changeable when it comes to whether they beat or miss. So not a reliable outperformer when it comes to earnings. This time around, 170 expected. That's up from 147 seen last time around. In terms of some of the concerns that people have been having, it is this feeling that Oracle are over leveraging themselves into this AI play. You can see here in terms of the comparison between, say, Alphabet and Oracle, and the notable difference here is the free cash flow when it comes to Oracle, which is in negative territory and dropping off in a really meaningful manner. You don't want to leave yourself in a position where you don't have any cash, right? You're just using all of it. And Oracle appears to be burning through cash. And therefore, it feels like they're essentially going sort of Hail Mary for this. Maybe it pays off. Maybe all this investment turns out into something that absolutely makes an incredible company. or maybe it doesn't, and they don't have anything to fall back on because they've just completely gone hell for leather on this AI play. Now, one of the reasons why it really has grabbed the headlines over recent years has been the fact that when we look at sort of fears around the tech space and the possibility that some of these companies might go bust because of the over leveraging that we've got in terms of the huge expenditure on AI infrastructure and build out, the hyperscaling, so to speak. If you look at the credit default swap, the CDS for Oracle, that's the one that really has stood out. It's soared. So people are really starting to see this as a potential company that could fold if the AI play sort of unwinds in the way that some people are fearful it might do. So they're kind of at the forefront of it. And that's why I think this is a really interesting one to be watching for the week ahead. In terms of the chart, let's just jump onto it. And we can see here in terms of the Oracle chart, it's a pretty interesting one because we've seen that massive collapse here as the growth in that credit default swap level increases. So people become fearful that this company might just go bust. And suddenly that sort of AI exuberance turns into pessimism. And now we're coming into levels that you could say represent value because we've come into this sort of trendline support. We're back at levels not seen since sort of mid 2025 and then back in sort of mid 2024. This is an area of support that could hold. So it'll be an interesting one to see exactly how this plays out. And certainly people will be keeping a very close eye out on the free cash flow, the conversations around the tie-up between Oracle and OpenAI. And so, yeah, this is an interesting one, a very interesting chart, a very interesting narrative around AI and tech coming at a time where people are starting to move back into tech, albeit because they're just fearful about what's happening in the real world. And quite frankly, with gold selling off, silver gold selling off, physical companies selling off, prior to that, tech companies and AI companies selling off. I mean, it's tough to find a little oasis or a little haven nowadays because things are changing so much. But very interesting times to be a trader. That's all for today. Half an hour's worth. Yeah, more content like this. Make sure to check out our channel. I'm constantly creating content, trying to touch on things that I think are particularly interesting within the market. I hope this has been useful to you guys. Make sure to like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead.